I'm obviously going to give you a little introduction and some background, which I partially just accomplished. I'm going to talk about comparing rate making between municipal utilities and investor-owned utilities. And my credential includes building rate cases for utilities. It includes intervening in various rate cases on behalf of large users in opposition to whatever the utility wants to do, and also in energy management. I'm going to talk about that process. I'm going to compare what I will call cash requirements as a rate-making philosophy against a cost of service rate-making philosophy, which is typically what investor-owned utilities do. I'm going to identify two issues that I think are kind of big deals, that I think the City Council should care about, I think that the citizens of Boulder should care about. And mostly what I do is think about the money-related stuff. In fact, nobody who hires our company really cares very much about fervor. What they typically care about is that they spend tens of millions of dollars a year on energy, and they would rather spend less than more. And I will talk about those two issues as we go along. I've given you my industry credential, and I really appreciate municipal utilities. I think they are elegant, and they are, in my opinion, economical as long as the governing body, which you can read as City Council, cares about the money. If the City Council cares about the economics, I believe municipal utilities provide a wonderful service. I have no financial interest in any outcome other than that of a ratepayer in Boulder. Nobody's paying me to be here. I met Pat Murphy, and I was interested in meeting Pat because I wanted to meet the savior of the Sanitas Trail. And I had thought he was crazy and wanted to meet him, and after meeting with him, clearly he is crazy. For me, this issue is not one of evangelical fervor, it's one of simply getting it right. The U.S. Navy has a postgraduate school in Monterey, California. And one of the schools that's on that campus that's run by the Department of Defense is called the Defense Resource Management Education Center. It's for senior level military officers and senior civil servants. And when you walk through the door, there's a sign, and it says, "It pays to think, and somebody wants you to." Another elegant statement, and I've embraced that, or tried to embrace it, since I attended the school. I am a technician and not a zealot. And you will see that as I move through this, and I will attempt to convert the jargon of my business to something that is understandable. First, the rate-making process. A municipal utility typically uses a cash requirements method for generating rates. So that means, pardon me, that means that the utility manager will build a budget for a year or 2 years and take that budget to council and tell council that I need new rates or higher rates in order to pay the bills for the next year or two. The governing body approves. One of the critical elements of that is that first it's streamlined, it happens in almost no time, and there's an absence of professional adversarial staff. There's nobody at the city paid to fight the city. An investor-owned utility is a regulated animal. Every state has a regulatory body, and that regulatory body is there to regulate the rates of investor-owned utilities. The investor-owned utility uses something called the cost of service model, which is a good bit more arcane than the cash requirements. And an IOU will request new rates from the regulatory body, in our case, the Colorado PUC. And there is a Colorado PUC staff that is paid to oppose that rate increase. In addition to that, in most states, and it's a relatively new animal the last 20 years or so, there's a consumer advocate who is paid to do much the same thing, but without any kind of intellectual rigor attached to their arguments. The last thing I want to talk about here is the intervention process comparison, and specifically executable models. In the business that I work mostly in regulated utilities, a utility requests a new rate, and immediately the staff of the commission says, "This is nice. Send us executable economic models." That is to say, send us something we can wallow in and analyze. So an Excel model is what is preferred in our business. And a utility that is unwilling to do that is going to get slapped around by the regulatory body and probably be compelled to come up with what is called an executable model. And obviously, in our situation, no such executable model is available, and I suspect won't be. Next, I want to talk about the cash requirements versus the cost of service rate making. And I'll talk about revenue requirement comparisons, cost allocation and rate design, and cost causation differences. This is a chart about which I am very proud and hope to copyright it one day. It's so pretty. And it took forever to build, especially if you don't know what you're doing. Now, what I've attempted to do is show you the comparison of cost of service elements with cash requirements elements. The easy one is operation and maintenance expense. An investor-owned utility wants to recover its operation and maintenance expense. Let me back up. The sum of these two columns equals the total revenue requirement, and the revenue requirement is simply the amount of annual dollars that the utility needs to pay all its bills. In the cash flow model that the city has offered, it talks about two line items, O&M, operation and maintenance, and city overhead. And these two things are roughly equivalent and accomplish the same thing as O&M in an investor-owned utility. In an investor-owned utility, we have a revenue requirement element called depreciation. In the municipal utility, we have a portion of the debt service, which is principal. These two items are designed in a rate-making context to recover the investment of the utility. If a utility is frozen in time and it never invests another penny, by recovering the depreciation, it will, over the utility's life, recover all the investment that it had in the utility, so that as the last electron flows through that system, the utility will have recovered all of the money. And the same thing is true of debt service principal for a municipal utility. Next, we have something called taxes other than income taxes, which mostly is property taxes. Utilities pay significant amounts of money to counties within which they operate for property taxes. A city isn't really required, I don't believe, to make a payment for property taxes. It's exempt. But what it typically does is collect from its customers a payment in lieu of taxes so that it can advance that money to the county and the county will stay whole. It's a pretty reasonable thing to do. An investor-owned utility pays income taxes and collects those income taxes from you. It tickles me sometimes when somebody, for some reason, will see that perhaps some legislature wants to reduce income taxes of corporations, and that person won't understand that when a corporation that is also a utility has a reduced income tax, that flows directly to ratepayers, because the income tax is a component of the total revenue requirement. I've put a nice blank here because there's no such animal in the case of a municipal utility, and it's a significant advantage for a municipal utility. A municipal does not have to collect income taxes that it subsequently pays from its ratepayers. Return on rate base is an arcane subject, and it's worth a lot of discussion, but it is simply the weighted average return between debt and equity on the net investment on which the utility is allowed to earn by the regulatory body. Rate base is that net investment. The comparable component of revenue requirement is the interest in debt service. The municipal utility typically finances a very high percentage of its investment with debt, and that interest is roughly comparable to the return on rate base. And typically this return on rate base will be significantly higher than the municipal interest rate. And I realize that the city, because of the circumstances under which the city will be purchasing various assets, it's going to have a taxable interest rate. That is to say, the creditor has to pay taxes on the interest received from the city. But 30 years from now, if the city is still operating the utility, it will probably be issuing debt for its various purposes that is indeed tax exempt to the creditor. Municipal utilities often include capital improvements in their overall revenue requirement, whereas investor-owned utilities don't. What an investor-owned utility will do is, as its rate base builds through investment, it will go in for another rate increase. I like the idea of capital improvements as long as it doesn't hamstring the ratepayers. But so here you have all of the elements that a city has to recover to operate a utility from its ratepayers, and the same for an investor-owned utility. There is this process that I sometimes refer to as equivalent to that big machine at King Soopers where you take your change and you dump it into this machine, and it separates everything into these nice little piles of pennies and nickels and dimes and quarters. Well, the cost allocation rate design process is similar to that. It takes a revenue requirement and it dumps it into the coin counter several different times and comes out at the end with regs. And I'm going to define some terms so that when I use them, they'll make sense. A utility function is and these are my definitions, and I've given testimony with these definitions, and I haven't been put in jail yet. So I think it must work okay. But a utility function is a sequential value-added activity with identifiable costs. And I'll show you some of those in just a minute. Cost classification is the identification of costs based on customer attributes, usage attributes. Cost allocation is the assignment of costs. And when I talk about cost, you can think about the revenue requirement. It's the assignment of costs to customer classes based on customer class usage attributes. Then rate design is simply the method by which the costs are collected from customers. Another elegant chart of which I'm proud. Each of these boxes is the total revenue requirement that an investor-owned utility has to recover. But it is examined in different ways. So we start off with the revenue requirement that we just talked about. Remember, we had that chart with the elements on it. And this, by the way, is an investor-owned utility. This is the way investor-owned utilities, almost every place in the United States, do their business. That revenue requirement is then separated by function. And the big functions in an electric utility are production, which is really the big boy. That's where most of the money is, and that's where most of the costs are. High voltage transmission, distribution, and then customer-related charges. So theoretically, you can take this revenue requirement and separate it into each of these 4 functions, and you'll still have the same total. The next thing that happens in the cost allocation process is that that revenue requirement by utility function is then classified by cost causation. You put a demand on the system, and there's 8,760 hours in a year. And during that year, there is a time when you put a peak demand on the system. The utility has to be ready to serve that peak demand with dispatchable power. Dispatchable power is stuff like coal-fired power plants, natural gas-fired power plants. And so you put a demand, and the next thing is during that year, irrespective of the peak demand, you will use a total amount of energy. And that is another cost causer. And the third thing that causes cost is your presence on the system. Every customer has a meter. And whether you take any electricity or not, the investment in that meter exists, and the costs related to that investment are going to be paid for. The next thing we do is take this revenue requirement that we have functionalized and classified, and we assign it to customer classes. So in the case of Public Service of Colorado, there are residential customers, commercial customers, what are called secondary general, primary general, transmission level customers. Those are the big classes. And now each customer class has a portion of the revenue requirement for which it is theoretically responsible. And then the last thing we do is design rates. And this is simply coming up with a method by which to get the money. So if you're a residential user, you don't want to pay a flat demand charge based on the costs related to your peak demand. You would rather pay that over an energy charge. So on Public Service Company system, and this is true elsewhere as well, most of the residential costs are collected through an energy charge. But the demand-related costs that we talked about here tend to be collected through a fixed charge per kilowatt or megawatt of peak usage during a month. And this from industrial and large customers. Cost causation differences among customer classes exist for 2 reasons. One, customer classes don't use the same facilities. And second, their usage profiles are different. And I'm going to show you some things which will focus on those 2 cost causation issues. And in the case, for instance, of public service, and I want to kind of drill this, public service has about 20 what are called transmission level customers. And I counted the 20 off of Public Service Company's tariff. Each of those customers is identified. Those transmission level customers do not pay for distribution related costs. And you will see later that distribution costs are about 1/3 of the total costs on Public Service Company system. Transmission level customers don't pay for them because they don't use them. And their cost causation behavior shouldn't require them to use that. A transmission level customer typically takes title to his electricity upstream of a big substation at high voltage. And then the customer itself is in charge of a step-down transformer and its own distribution. That's a pretty good example. And a high demand, a customer whose average usage over a year is very close to his peak usage, and think about 8,760 hours. And you add up all of the usage in those hours and divide it by the peak hour, and you come up with load factor. And a high load factor customer would be something like a glass manufacturing plant that uses on a continuous basis about the same amount of electricity all day long, every day. That's a high load factor customer. That is to say, his average usage is very close to his peak usage. And what will happen is those costs that vary with peak demand will be charged to him, and then if you think about them being divided by the number of kilowatt hours, his rate will be very much lower than a residential rate who is paying for a peak demand but the rest of the time doesn't use that much. I would like to talk about compliance with ballot issue 2C. A lot of people have seen this ad nauseum, but you will notice that there's a point in here where it says that the utility, in order to satisfy the rate constraint in ballot issue 2C, has to be able to charge rates that are no more than what Public Service Company would charge and collect its debt payments. So debt payments is kind of a key in that. And the truth is, the debt service payments, the principal and interest on whatever the debt is that the city uses, is going to be a big gob of money. It is going to probably dwarf everything else. Now, I say dwarf everything else. It's not going to dwarf purchased power. But if we had our own power plant and we had to buy a power plant from, say, Public Service, then the debt would be significantly greater. But that debt payment is important in the movement towards our municipal utility. I don't know what the city is going to do. I would rather be dragged by the tongue around Boulder County than go to a city council meeting. I tried watching it Tuesday night, and after about 2 hours, I went screaming from the room. It was simply more than I could stand. So I am not an expert on the city's business with respect to the municipal utility. For one thing, nobody pays me to do it, and if I have a choice between spending time getting paid or spending time not being paid, because I'm so greedy, I'm going to do the former. So the way I think about this is I establish a hypothesis, which is kind of a conclusion that you're not really willing to lay across a railroad track for yet, but you think it's something worth testing in the real world to see if it really is true. And my hypothesis is that the city does not intend to include debt service in its revenue recovery. And if it doesn't, of course, the implications are fairly obvious. It removes any barrier that might be available through ballot issue 2C. And the reason I have the hypothesis at all is that I've looked at this cash flow. And in the cash flow, the city is showing on this document that it's not going to recover debt service for the first year and a half of the utility. So the city, I believe, calls it capitalized interest. That ain't what it is. I know capitalized interest. Capitalized interest is used under different circumstances. What the city would do, if I'm right, is simply defer payment. You know, investment bankers are smart people. They're smarter than me. And I have seen what investment bankers can do when challenged. And if an investment banker has an opportunity to issue an enormous amount of debt, and the potential debtor says, but I need to defer payment on interest and principal for a year and a half, that investment banker will find a way to do that. The way to test my hypothesis is to examine first the debt service schedules which support the cash flow model. Now I know that from what I understand, the city says, well, this cash flow model is proprietary, somebody owns it, we dump a bunch of numbers in and a bunch of numbers are dumped out. But it is inconceivable to me that a financial person at the city isn't running debt service schedules. And a debt service schedule is nothing more than figuring out what the principal will be and then the payments over time. Now, most of the municipal debt service schedules I'm used to seeing show payments every 6 months of principal and interest. And I'm sure they can be modified, but the debt service schedules that the city will eventually propose will tell us very quickly. So if it shows $150 million of debt, and then the first month no payment, but interest accruals added to principal, and the second month the same thing, and on for 18 months, so that the interest isn't forgiven, it is simply added to the principal of the debt, so that when the ratepayers start actually paying for it, there's a match between what the ratepayers pay and the actual payments made by the city. And I guess another thing is somebody could ask the city if the hypothesis is correct. That's probably the easiest thing to do. I don't go to city council meetings, so I can't be the one to do that. My tentative conclusions are that the interest and principal on the debt related to the assets in service, and I say it that way because in the utility rate making business, we use a term called the matching principle. And it is applied in different ways, but typically what it says is, if you're using a service and getting the benefit of the service, you should pay for the service. You should pay the costs related to that service, and you should pay them currently. And that interest and principal on the debt related to these assets that are going to be purchased and be in service on day one should be included in currently recovered operating revenue. Actually, the statement itself is kind of sophomoric because it's so obvious. Operating revenue should be matched with the costs to provide the service, which is really a derivative of number one. Capitalizing the interest related to in-service assets perverts the regulatory principles on AFUDC, which is allowance for funds used during construction. And capitalizing interest is indeed a common practice. If you have a construction project and it takes you 2 years to get it done, you are investing and financing that project every month. And most regulatory bodies allow you to capitalize the interest. That is to say, add the interest that you are paying as you build this asset on top of the asset's value. If my hypothesis is correct, ballot issue 2C is no constraint on the city at all. In fact, it's meaningless. And it doesn't matter how much debt. I guess there's another ballot issue that says the city won't borrow more than $214 million. I think that was a 2013 ballot issue. And perhaps that would be a constraint. But 2C becomes meaningless if the city intends to defer the payment for debt and the corresponding revenues related to that payment. Normal regulatory principles. First, allowance for funds used during construction, AFUDC, is what I just explained. And yes, there are special situations for capitalizing interest. Let's say, for instance, that the city borrows money for system acquisition prior to service commencement. So it borrows the $150 million on January 1st, but it can't really start providing the service for 3 months. Well, capitalizing the interest on that before the assets are in service makes perfect sense, and I believe would comply with most regulatory principles. Current service should be responsible for current costs. And to the extent the city decides to delink those things, it will be perverting normal regulatory principles. And you know, one quick thing, a municipal utility is not regulated, and there's a good reason for that. And what we do in Colorado is consistent with almost every state I've worked in. The legislators and the statutes acknowledge that a municipally owned utility has the potential to be a self-regulating animal. It doesn't need regulation because the voters are the ratepayers, and the ratepayers are the voters. So if a governing body, the city council, does a poor job of operating that utility, the voters can vote them out. Well, that makes pretty good sense. However, not all ratepayers are voters. IBM, and I don't know anybody at IBM, is sitting out there as a transmission level customer. I don't know how much they use, but from looking at the tariff, they must use a lot of power. IBM does not vote in the city of Boulder. And no corporation that is a ratepayer votes. So there's a delinkage then between the ratepayer and the voter if you are an industrial or business user of power. And that is a flaw. And I confess to you that I have made a really nice living from predatory behavior that is visited on large industries from municipal utilities. And I always look forward to finding small municipalities that have big industries in them, because I will always find something that demonstrates to a potential client or an already client why it is that client is subsidizing residential users. And it's like giving them firewater and face paint and building a big fire. They really start to go nuts. And I only have one anecdote. There's a city in northern Alabama on the Tennessee River called Decatur. And it runs a municipally owned utility and provides utility services to big industries on the Tennessee River. Some years back, we were asked to examine a big high fructose corn syrup plant's natural gas business with the city. And as we dug into it, we discovered that the city had decided in its wisdom to charge all of the ratepayers, including the big industries, which, by the way, were 80% of the total throughput on the system. Decatur had decided to charge the big ratepayers for the for the debt related to the municipal amusement park. And when we identified that for our client, within about a year, the client had bypassed the city of Decatur, gone directly to an interstate pipeline, and the city of Decatur no longer got any money from the client. That's my best example, and the most fun, of course. The next issue I want to talk about is customer classes and cost allocation rate design, and some of the implications for us here in Boulder. My hypothesis is that the city has not yet considered differences in customer class rates. Obviously, Excel has a significant activity where it goes through that cost allocation process that I showed you earlier. Excel performs a series of calculations to functionalize, classify, and allocate its annual revenue requirement, and then design rates based on those calculations. So how will the city recognize the cost causation between customer classes, or those differences? The example is the one I gave you a moment ago about transmission level customers who take power on the high voltage side of a substation. Excel assigns no distribution costs to that customer class. Does the city intend to charge its transmission level customers for a portion of the distribution system costs? That is, the debt service on the distribution system acquisition. And of course, the distribution system acquisition is going to be significant and material because it is probably going to be some amount greater than the net book value of the asset. That is to say, the gross cost of the distribution system in Boulder less the accumulated investment recovery over time, or accumulated depreciation in accounting terms. So to test my hypothesis, somebody probably ought to ask the city whether it intends to require primary general, secondary general, and transmission level customers to subsidize residential ratepayers. I've thrown primary general and secondary general in here because they too use smaller parts of the distribution system than residential customers. If the city intends to acknowledge cost causation attributes, what happens if a customer class does not satisfy the initial rate constraint of ballot issue 2C? That is to say, if cost causation is the basis upon which rates are designed, a transmission level customer in our city is not going to be responsible for any of the costs related to the acquisition of the distribution system, which means the residential and small commercial customers are going to get pretty well loaded up with that debt service. And it is conceivable to me that that shifting of cost, it's not really a shifting of costs, it's an appropriate cost assignment. That assignment of costs may trigger ballot issue 2C, but of course if the city doesn't collect debt service, who cares? It doesn't matter. The 2C will be no constraint. I have 3 slides that I offer to show you that one of the people I work with can really work a PowerPoint presentation. This is the functional cost of service, or a representation of the functional cost of service that Excel performed the last time it did what is called a class cost of service study, where it goes through all of that calculation process to identify cost pools for various customer classes. But the first thing we do, as you'll recall, is functionalize these costs. Notice that the distribution system costs are about 36% of the total right now. I'm showing 44% as production, but this is a grossly understated percentage. And I tried in the last couple of days to get some information from public service, but the contact there just wasn't available. The reason this is understated is because this deals only with the assets of public service, and it should, to be more valuable to you, include the purchased power, which is the cost of purchased power is more than the costs related to the assets that are operated by public service. Purchased power on this system is a big deal, and I have not reflected it here. This $1.355 billion is the total cost of service from the 2011 class cost of service study, and it's understated by probably $600 million, almost all of which is purchased power. This is another indicator of a problem. I defined load factor, I think, a few minutes ago by telling you that the average usage over 8,760 hours divided by peak usage is load factor. Well, if you use that calculation, residential users have a 38% load factor. That is to say, they put a demand on the system for their peak usage one time, and most of the rest of the year, in fact all of the rest of the year, it is using significantly less than that. And of course, intuitively, you know that's correct. As you go up the hierarchy, you'll see that commercial and industrial primary and transmission have very high load factors. That is to say, they're running all the time, and they use power all the time, and the average usage over a year is much closer to their peak usage. One of the fun things, which I show for contrast here, is traffic signals. Now, there's no money here, and it doesn't matter. But a traffic signal operates at a 100% load factor. Why? Because it's on all the damn time. And its peak is exactly equal to its average. So it has a 100% load factor. The share of the revenue requirement from the 2010 class cost of service study is shown here. And it shows you that 40% of the dollars in the public service company system are recovered from the residential users, and then 39% from the commercial and industrial secondary voltage customers, and as you can see, a very small percentage from transmission right here. This is a comparison for you, and it tends to show the relationship between all the energy used during a year and the share of costs on public service company system. So for instance, for residential, you'll recall from the pie chart, uses 40% of the total, they're responsible for 40% of the total cost of service, yet their usage is only 30%. And you see a crossover right here where usage is slightly higher. I would call this equivalent in the C&I secondary. And then as we move out, you get this transmission. And they use 9% of the energy and pay only 4% of the costs. One might say, well, that's unfair. It's not unfair at all. It is simply acknowledging the cost causation behavior of that transmission, of those transmission level customers. I think that's the end of, yes, the end of my presentation. And is there time for questions, or should I wait time for questions? Does anybody have a, yes, sir?
Go back to slide 6, the chart you're very proud of. It's a nice one.
I'm highly skilled. Yes.
So I'm return on rate base equivalent to debt service interest. As a Excel customer, am I not paying the interest on their bonds?
Yes. Excel, 44% of its capital structure is debt. 56% is equity. It is the ownership of the company by the shareholders. And the way that return is calculated, and I perhaps should have, I didn't know anybody would ask a question like this. So you caught me, yeah. Well, it gives me a chance to show off. I mean, how many people here in the room know that their capital structure is 44% debt and 56% equity? Oh no. Shoot, I thought I was the only one. Now I just learned it, and I will unlearn it by tomorrow. This will all go out of my head. But if you take 44% times its weighted average cost of debt, you come up with a component cost to apply to rate base. Do the same thing with return on equity. And the difference between return on equity and debt is that debt interest is pretty much actual. It is what has been negotiated by public service in the marketplace. The return on equity in a rate context is a percentage that is granted by the Public Utility Commission. So Excel will say, I need 12% on equity. And the staff of the commission will say, not so fast, you need 8%. And then someplace in the mud wrestling, they'll end up with, say, 10. And that 10%, when multiplied by the 56%, gives you another component. Two components added together is the return on rate base.
Yeah, so I was just thinking that return on rate base has interest and return on equity, and municipal utilities are equivalent to their return on equity?
No. The fact is, and you know, I was telling you earlier on that I love municipal utilities and think they're elegant and have the potential to provide an incredibly economical service. And the reason is because their cost of money is lower. Their cost of money is lower. The utilities, the investor-owned utility has a combined cost of money. It has to attract investors, and it has to give those investors a return, or nobody's going to buy their common stock. So they have to do that. And then they have to pay interest on debt. And that interest is taxable to the creditor. So it might be 6%, but the municipal utility, and again, there's a difference because starting up our system, the municipality is going to have to issue debt, which the interest of which is taxable. So it's going to look more like an IOU debt. But the truth is, I often talk about the pre-tax return on rate base. That is to say, the return on rate base plus the income taxes related to the equity component. And for public service, it'll be 10.5%, 11% from the last rate case. And the debt service, I think the city is looking at 6.5% debt. And that's a significant difference, and to say otherwise is just to defy mathematics.
Well,
yes?
It's mixed. I mean, some is taxable and some isn't. The acquisition costs are taxable.
That's what I understand, yes.
But not the capital, capital costs or investment in the commission.
Going forward.
going forward, or even at the time of creating the utility,
Yeah.
as long as that's not part of the acquisition.
Got it. Yes, sir.
Yeah, I appreciate you being here. The slide on the cost allocation and rate design was very interesting and very helpful. I do have a question. You have two issues that you present, and each issue you have a hypothesis, and you say those could be answered if you could just ask the city. So I'm wondering, why haven't you just sent an email to the city? My experience is they've been very forthcoming to respond to citizen requests.
The truth is, I haven't, because I haven't taken the time to do it, and there are plenty of people who are possessed of evangelical fervor who should do that.
Okay, but I mean, you're here presenting us. You're taking, I don't know, an hour of your time that you could have spent writing a letter to the city and getting a response. I just don't understand it. It doesn't make sense.
Yes, sir.
On that same slide, the two blank squares there,
Yeah.
how do they compare to each other? Are they essentially equal, or is one
Well,
much bigger?
if I understand the question, I put the blank slide here for income taxes because there is no income tax in a municipally owned utility. So the investor-owned utility has a component of its revenue requirement that does not exist in a municipally owned utility.
Right, and the same sort of goes for capital improvements on the...
Yes, now, the city in its cash flow shows some capital improvements, and that's not uncommon in my experience. They often put capital improvements into their rates so that they can, for instance, avoid debt. I'm pretty sure that the city of Fort Collins, for instance, has no debt on its distribution system. If it does, it's sneaked by me in their financials. And if that is true, it's because they finance with current rates the capital improvements that they want to make from year to year. Whereas there's no method that I'm aware of in a cost of service environment unless a regulatory body decides to do something, and I've seen, for instance, nuclear plants that get to recover various capital costs from decommissioning, which would otherwise be capital costs. But it's a specific situation that causes that to happen. It's not common, I don't think.
So if we could hold off on